Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. I got a really interesting gentleman to introduce you to tonight. Jeff Thompson is his name. He's the Vice President of Asset Management at Magellan. And he very frequently on both LinkedIn and X, the former Twitter, posts about what's going on in the investment business, particularly as it relates to real estate. And he's got some really poignant opinions. He hosts fairly frequent podcasts and X, Twitter, live discussions, etc. So I thought it would be interesting to check in with what a guy that's in the investment business actually thinks about this real estate business and what some people are calling a housing crisis and etc. So Jeff, welcome to the show.
Well, thank you, Brian. I appreciate you bringing me on.
So you focus primarily on real estate investments, is that correct?
That's correct. So Magellan is primarily an industrial company. We own assets across the United States. And as I said, we focus on industrial with a little bit of office.
But lately you've posted a little bit about housing crisis, housing affordability crisis as well. How come?
Yeah, exactly. I mean, I think it's a very important issue that, we all have to come to grips with here, especially in Toronto and the GTA. Affordability really is a big problem here for everybody. And I think it's important to highlight some of the things that we could be doing to help make that better.
Now, you were very critical recently about big increases in development fees, DCs. Tell me what was bothersome to you and what's your opinion?
I think it's important to recognize that, housing is important to everyone on the income spectrum. And not many people really understand the costs that are associated with creating new housing. Governments need to pay for things, and we understand there are fees associated with, bringing those services forward. But the increase in development charges is a particular item that I think needs to be focused on if we're really going to take aim and make housing more affordable.
Now, Jeff, you and Daniel Foch quoted that development fees in 25 years have gone up 9,000%. 9,000%. From $1,617 to $117,169. 9,000%. Has anything else gone up by 9,000%?
I'm not sure. It's been, these charges have been on the increase for many years now. The government or multiple levels of government have done a lot of different things to help with this affordability crisis. But I think this is one area they do need to look at a little more closely in order to really start reducing the costs that it takes for developers to deliver new housing to the market.
What's the justification for the development fees to go up from 1,600 to 117,000?
To be honest, I don't know the specific reasons. As I said, they've been on the rise, more dramatically over the last 10 years. As we know, inflation is a real problem and has been since COVID, and I think that does and has played a factor recently because it costs more for cities to deliver services and create new infrastructure to go along with this.
But inflation was what, 5-6%? Last year, you said they went up by 42%.
Yeah,
that's a little bit more than inflation. That's like 10 times inflation.
Exactly. It's a bit much, in my opinion.
A bit much. You're the master of understatement. Like 9,000% in 25 years, 42% in 1 year. So I happen to believe that it's a regressive tax because it's a tax paid for by young people that want to buy a home, get into home ownership. It's a tax paid by renters that want to get into home ownership. It's a tax paid by newcomers that are coming to our society. And there was a description about a week or two ago of all the things that it pays for. And it pays for water and pipes and sewers, but it also pays for libraries and police stations and fire stations and things like that. We are putting on to young people that want to own a home in the middle of a housing crisis, a huge amount of costs that all of society should pay for. Are we not?
I agree. I agree. You know, this affordability crisis is just that. It's a crisis, and we really need to take a hard look at how we're funding these critical services, and is this the best way to do that? Um, I feel like it needs to be a full frontal assault on reducing housing costs across the board. You know, whether that's a new condo or a single family home.
So
You
other
know,
than development charges, what would you do?
uh, well, I know the government's already put in place low cost loans. Um, you know, the cost of building materials is another item that is really seen a rise. And you know, we talked about inflation. That's one of the areas that's been hit more dramatically. You know, I'm not sure how the government would go about subsidizing that, but you know, if you could find a way to reduce those costs as well as labor, it would go a long way.
CNBC and Stats Canada have done an analysis that says that Canada is the slowest country in the Western world to approve development, and that Toronto, Mississauga, Victoria, Vancouver are the slowest cities in the slowest country, and suggests that red tape regulation, all the NIMBYism, all the approval time periods are a major cost to developers and a major impediment to development. What do you think? Do you agree or disagree?
Yeah, the timelines are do add to the costs. Carrying costs of the land and the insurance and the loans that developers need to take out in order to execute on these projects. So, um, red tape is definitely a problem as well.
Now you're in the industrial business primarily, you said. Is industrial the same? Does it take a long time to get approvals for industrial development?
You know, we operate in the U.S., so timelines are a little bit quicker there. You know, they seem to be a little bit more friendly to business investment. But you know, with the right zoning in place, industrial can move quickly here in Canada as well.
I was talking to a businessman who had a factory in the Niagara region, and he said that if he moved to Niagara Falls, New York, he could get land at a quarter of the price, and he could get approval time periods in a third the time, and the taxes are lower. Do you believe that?
I do. I do. I do.
So, what have we got going wrong? Like, what is it that has us in the middle of a housing crisis have substantially higher development fees? I saw another report that said that Los Angeles had the highest. I think they have a different name for them in the United States than development fees, but
Yeah.
they the highest fees in the United States, and it was like less than $2,000, and we're over $100,000. So the U.S. does have the equivalent of development fees, but order of magnitude minuscule relative to us. They have faster approvals. They have lower land price. What is it that we've done wrong in Canada?
I wish I had the answer. You know, I like to focus on the solutions, and you know, we are taking steps. You know, the governments have taken steps. You know, with the HST or the GST, HST elimination from the rental construction. You know, we just need more. And as I said in my post, I think development charges are a really big piece to this puzzle, and we need to take a look at those a little closer.
I agree with you on development charges. I also think that we need to think very seriously about the time frame for approval. I think that whether it's in industrial or residential or retail, in the mining and resource business, people say that the development approval time period is twice as long in Canada as it is in the United States. And maybe you can explain. You're a business person. What does that extra time do to an investor? What's the impact?
We'll give you an example. So if you had bought a site, a development site, in 2021 with the hopes of developing it, the 2 years that it takes you to actually get to that place where you're going to put a shovel in the ground, your construction loan just tripled in cost. So with the rise in interest rates, so the delays can have meaningful impacts, and especially more recently. But we would really have to uh, you know, people do need to have a say in what gets developed in their neighborhoods. Um, you know, it's just about finding a more efficient way to get this process done and allow people to have their say at the same time. I don't know how that that would happen, but you know, again, we have to look at that.
I agree that they deserve a say, but NIMBYism, I think, has gone a little bit far. I heard a new term just this past week called CAVE. Do you know what CAVE stands for?
I do not.
Communities against virtually everything. So it's taking NIMBYism to an extreme. And I do think that, some of the things the provincial government have done of late, trying to limit the amount of appeals, the amount of people that can get involved in the process to object, how long you can take that process out. And it's not just the time value of money that you talk about with the construction loan going up. It's risk, is it not? It's that you've got to, when you
Yeah,
think about a discount rate, when you think about, the demanded return that you're going to demand on a project, if it's going to take you 5 to 7 years to get to know whether you can actually proceed, and you may actually have to go to the Ontario Land Tribunal and go through a litigious process to get approvals, the risk goes up. And so when the risk goes up and the time goes up, the discount rate goes up, the demanded return is higher, and less gets built. No?
you're bang on. Um, you know, I think municipalities need to really take a hard look at what they're doing on with their approval processes and um, you know, accept the fact that housing needs to get built. It needs to get built now, and try and work with the developers as best they can to bring housing to market in a way that works for everybody.
We're chatting with Jeff Thompson. He's the Vice President of Asset Management at Magellan about the housing business and about a thing he's got once a week on X. What's it called that you do?
Uh, well, it's just called Real Estate Spaces at this point with my friend Daniel Foch and Tyler Alley, who's actually a retail developer down in the United States who we've teamed up with.
And
It's a
Spaces
weekly
is like
show.
it's a live discussion. Is that correct?
Correct. We talk about all things real estate. Last week we were talking about retail. This Thursday at 12:30, we'll be talking about all things industrial. So
Fantastic. And how does one connect into it? You follow yourself and then it pops up on your Twitter feed?
correct. And you can, I have a post pinned at the top of my profile where you can set a reminder, and it will ping you when the show started.
Fantastic. Sounds interesting. I'll have to plug in. We're going to take a break for some messages and be back in just 2 minutes talking more about real estate investing, etc. Stay with us, everyone. Back in two. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Jeff Thompson. He's the Vice President of Asset Management at Magellan. He invests primarily in industrial real estate, but he also has a Spaces conversation about real estate every week, and they talk about residential, retail, office, etc. And he's posted quite frequently about the housing crisis, about development contribution, development fees, etc. And so I thought it'd be interesting to have him on. I got to ask you, you had a picture of a hat and it said, "Make 4% caps great again." What do you mean by that?
Well, first off, that was a hat that a gentleman down in the U.S., someone that I interact with on X, put out there and actually supports a veterans support charity. So that was the primary reason that I purchased that hat. But you know, the cap rate implies the return for the property, and maybe a return to better times with
So
lower cap rates.
explain to everyone what would happen. What's a comparable cap rate today?
Um, you know, industrial, which is my forte, you know, was really the belle of the ball, especially, you know, during the COVID era where logistics and the demand for warehousing was quite substantial. You had warehouses that were trading in the threes. and low fours in terms of cap rate return on investments. So prices were very high. Today we're closer to 6 or 7% cap rate on comparable product. So
And
quite the
so,
shift.
and so if a 7% cap rate declined to a 4% cap rate, like your cap said you wanted it to make 4% cap rates great again, what would happen to the value of an asset?
It would go up substantially.
And that's because of what?
The return would be it would be a lower return based on the NOI.
So that the return that the investor demands would be lower, and so
Correct.
therefore for any given net operating income, the value of that property would go up dramatically. And if it was an 8% cap rate today, declining to a 4% cap rate tomorrow, the value of the enterprise, the value of the property would double, correct?
Exactly.
So these cap rates that have gone up reasonably significantly during the last couple of years as interest rates ran up have really had a detrimental impact on the value of REITs, the value of real estate, the value of all properties out there, have they not?
Most definitely. We've seen it pretty much across the board in all asset classes, most poignantly in the office realm. As we all know, the work from home, measures put in place. We still haven't seen the return to office like we had prior to COVID. So office values and demand for office space has really fallen off a cliff,
Do you
unfortunately.
work from the office or from home?
I primarily work from the office. I do have some flexibility, but most of my time is spent in the office.
So, I've been downtown Toronto a bit lately, and Mondays and Fridays, it's a ghost town still.
Sure is.
It gets back up there on Tuesdays, Wednesdays, but Mondays and Fridays are a ghost town. How can all those, commercial establishments that do your dry cleaning and cook your lunches and things like that, how can they survive on only 3 days worth of business?
They struggle. They struggle. There's definitely been a reevaluation of asking rent in some locations, specifically in urban core. But on the flip side, in our space in flex industrial, we've seen rents in markets such as Atlanta doubling, and going up quite a bit. So it really depends on where you are and what you're renting.
So let's stay with office for a second here, if we could. I've heard that the vacancy rate in all office is like 30%, but in Class A office, it's less than 10, and it's substantially higher in C and worse office space. So it's been a flight to quality. Is that what you understand?
Yeah, absolutely. We have some office buildings in Chicago and Houston, and both of those markets, that is the story. You see, tenants that are maybe in a B building or a B plus building, downsizing, but then going to a nicer quality building. Giving their employees a better office experience and reason to come in, is definitely playing a factor in the real estate decisions of a lot of companies these days.
Do you think this is going to continue forever, or are we all going to go back to the office eventually?
Well, I can't predict the future, but I do think there's going to be a lot of money to be made in office. If you buy right today, and in the right location, primarily, and the right quality, I think there's going to be a real opportunity, because eventually I think people will migrate back in greater numbers. Is it 5 days a week permanently? I don't know, maybe. But I think the greater likelihood is some degree of flexibility remains, in the work from home situation.
I'm told that you can buy some office space below replacement value. Is that correct?
Yeah, yeah, absolutely. I think suburban office is definitely, having a difficult time in some spaces. The question is, would you even want to buy it, below replacement costs? I've akined uh, what office is going through now to what retail went through 10 years ago, or maybe 12 years ago with the Amazon effect. And everyone was screaming apocalypse for retail, and that it was all going to go away. But as we saw, quality, properties like a Yorkdale or a Sherway have not only done well but really thrived. So I think you'll see a similar effect in the long term in office.
But the secondary shopping malls like Cloverdale and places like that have hurt dramatically and are now being redeveloped into residential.
Yeah, yeah, it's highest and best use, and if the demand isn't there, then you have to reimagine what you're going to do with your property. Some of that office product can be converted to residential. Those are often difficult projects to execute on, but in other cases, you may just want to, start from scratch. And some of those suburban office complexes have quite a bit of land area, which could be turned into condos or apartments or single family dwellings, obviously, depending on the market demand.
Many cities have, districts that are zoned for employment, zoned for office, and you wouldn't be able to actually build a condo even if there was demand for a condo or a rental apartment. And also, numerous cities are talking about giving permission for people to convert offices into residential. Do you think those two trends should change? That there should be more mixed-use development availability?
Yeah, absolutely. I mean, it goes back to what we were talking about earlier on our discussion with the approval timelines. These are rezoning opportunities, which require the public consultation and working with the municipalities to change the uses of these properties. So, again, another opportunity that our political leaders could jump on and fast track some of those approvals.
Last week, your spaces thing was on retail. What other trends do you see happening in retail?
I mean, the biggest thing right now is food. You see a lot of new entrants, especially into the Canadian market, like a Shake Shack and a Chick-fil-A. The demand for new food offerings is really strong, not only in Canada but in the United States. I've spoken with numerous retail developers. They are looking all over the country for single tenant drive-through buildings for tenants like Dutch Brothers Coffee. They're more in the southern United States. I think that is definitely one of the biggest things going on in
Why?
retail.
Why this big interest in eating out of the home?
I don't know. I mean, I love food. I like trying different things and, having it, easily accessible, and especially with a drive-through, which seems to be the most popular, format choice for a lot of, food retailers right now. Just because of the high volume of sales that they can drive, no pun intended, through these locations.
Yeah, I think it's got something to do with the pandemic and that we were all sequestered at home and maybe found, back our culinary expertise in cooking a lot. Now it seems like we've rebounded the opposite direction and want to eat out more. Even though, as you point out, some of them are complete drive-through. This Dutch Brothers, it's amazing. It's like a small Tim Hortons, and what they have is 2 and 3 drive-through lanes, and there's hardly any inside space at all. You're
Mm.
almost discouraged from going inside to get your coffee. All they do is serve it there, and they have a stacking that is for like 50 cars lined up to go through 3 and 4 drive-through lanes. It's
Yeah.
amazing just for coffee.
Yeah, they have quite the cult following. When I've seen videos of when they open up new locations, and it's lined up around the block. These, as I said, it's a cult following, and they really attract a lot of business.
Chipotle, and others are similarly expanding fairly dramatically, correct?
Yes, yes. And not to stay on coffee too much, but also Starbucks. A company that's sort of uh, reevaluated its real estate numerous times over the years, is another business that is expanding and hoping to open lots of new locations, mostly drive-through, in the years to come.
So it's interesting that there's so much focus on drive-through. What about strip malls? Are strip malls still a good investment?
I love strip malls. I actually I did primarily retail for the last decade prior to joining Magellan. And the local strip mall, is a thing of beauty. Especially if you have the grocery anchor. I think it's an incredible investment. If you have, especially if you have the grocery anchor, the ancillary tenants that go along there, pay great rents, and you really can service the community. You're a real important part in the communities that you serve when you own these properties. Um, and really enjoyed, meeting a lot of these tenants over the years, and getting to know them, and help grow their businesses and expand them, and conversely help them through tough times. I think it's about really important to support your local business owners um, when they're moving in either direction.
So my sense, please correct me if I'm wrong, is that grocery anchored shopping centers, cap rates have come down and are profitable and sort of fit the description that you've made. But the strip mall or strip center that doesn't have a grocery anchor and is just a bunch of fast food or miscellaneous stores is not doing as well, and the cap rates are pretty high. And so I've seen a real separation in the market between the grocery anchored shopping center versus the strip center. Do you agree with that or not?
I do, yeah. No, I've noticed that. It just comes down to location, 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 location. That's the pretty fundamental aspect of retail, or really any real estate investment. But I think most importantly, when you're looking at a retail asset, you need to be close to homes, high income homes, access points on the road. So you may see an unanchored strip center trade higher. That may not only be because of the investment market at that time, but also certain aspects of that asset may not be as beneficial compared to others.
Yeah, location, what's the market you're in? But some of the other trends that I think are interesting is those old shopping centers that may have had a mall, an interior mall, are being demalled. And a lot of these shopping centers are putting in out parcels, whether they be grocery stores, restaurants or banks or whatnot. But they're putting pads, all around their parking lots. And it seems like there's this huge benefit for convenience and proximity to where your car is. And maybe it's similar to drive-throughs, but people don't want to walk through an interior mall anymore, other than those fancy big ones like Square One in Yorkdale that you were talking about. But the sort of the secondary interior malls are going away. They're demolling, and they're adding in all these pads that have the banks and the Starbucks and the fast food restaurants, not as part of the shopping center, but out in the parking lot.
Yeah, that's exactly true. I've said it before, if you're in the retail real estate business, you're also in the development business, whether it's pads or a residential application around your site. These large malls, community malls, most are not viable anymore from an interior mall standpoint. So all the businesses, especially through the pandemic, wanted exterior access. That was critical to any new deal we were doing through that time period. And I think going forward, indefinitely, you need exterior access if you want to attract high quality, good rent paying tenants to your center.
You mentioned the Amazon effect. I think most people think that internet sales are like, somewhere between 13 or 15 or 17% of total retail sales. So they haven't taken over completely, but they have taken a significant slice of the pie of sales. And because of that, we've seen numerous different, retail brands suffer. Toys R Us, Mastermind, Bed Bath and Beyond. I could go on. What do you think is going to happen? Is that going to continue? Is that sort of that process of bankruptcies of some of these retail chains done? Do we have to watch out for others? What's your sense of things?
Unfortunately, yes. There are many businesses out there that just haven't grasped the reality yet of how important omni-channel is. And when I say omni-channel, I mean having a business that can interact both online and in the physical store. You buy something online, you want to pick it up in the store, you want to exchange it in the store. It all has to go together and be a seamless interaction for the customer. So some of the legacy businesses that are out there, just won't make it, unfortunately.
So retail is going through a fairly significant change. And you correctly pointed out, I think that the Class A downtown big malls like Sherway and Yorkdale and Square One and Eaton Center are still doing spectacular and probably will continue to do spectacular. But there's some entertainment value there in addition to just the retail therapy shopping experience that one gets. The secondary malls are really under pressure. I happen to believe that what I would call strip centers are under pressure, but the grocery anchored shopping centers are doing quite well. And so I would separate that. We talked about office and how Class A downtown office is okay, but almost every other office, suburban or B or C or D, are really under pressure and doing poorly. Given all that, and frankly, we've talked about housing affordability. Given all that, why is industrial doing so well? And has done so well during the last couple of years. Actually, you know what? Let's take a break for some messages and come back and maybe ask you then about why, given everything we talked about, has industrial continued to do as well as it has. Stay with us, everyone. Back in just 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Jeff Thompson. He's a smart real estate investor, primarily in the industrial space, but obviously, given our conversation, very knowledgeable in retail, which he spent a fair amount of time in over the course of the last decade or so, prior to his industrial experience, but then also in office and residential. He's vice president of Agellan, and Agellan is a real estate investment company. Is that correct?
Correct. We're a private REIT.
A private REIT.
Yeah.
Maybe we should talk about that a little bit. But let's go to the industrial sector. So why did industrial do so well during the pandemic?
Well, the demand during the pandemic for distribution facilities was so strong because we were all getting stuff delivered at home. It's as simple as that. Businesses needed places to store their goods, manufacture their goods, and distribute their goods. We were woefully under warehoused, and there has been a slight slowing in the industrial space in the first couple quarters of this year, but I still believe in the longevity of this sector. I think we're still under warehoused, and there's going to be strong demand on all size fronts in the years to come.
Jeff, I was out at the Hamilton airport a little while ago. The Amazon warehouse, the cargo jet warehouse, the DHL warehouse, they're all massive. And they're bringing in planes from the United States and China just filled with stuff, if not every day, every second day of the week. Like, what goes on here?
Well, the world's population is growing, and it's not stopping growing. People want to come to Canada. People want to come to the United States. The influx of people and the population growth here in America is tremendous. So there's demand for goods and services. So we need warehouses and retail plazas to service this increasing population.
But I think the interesting thing is that people are buying globally via United States or China or wherever via, Xi'an website or Amazon website or whatnot.
Yes.
In a way that historically they would have just gone to their local department store, and the department store would have bought internationally and brought stuff in. It's now individuals are buying it directly from some international sector. And so therefore the way that we're buying today has changed fairly dramatically. And that means that, all these different packages, get shipped individually from China to Canada and then distributed on someone's Uber or Uber-like van to our house. It's a very different supply chain system, is it not?
It is. It is. And, I think you're going to see, an increase in demand for that sort of last mile. Warehouses that are and distribution facilities that are closer to the urban populations. There has been talk about turning some of these, failing malls or strip centers into micro distribution facilities that allow these businesses to deliver these goods faster than ever before, which is what everybody wants.
Let's get back to housing, residential housing. And we talked off the top about the DCs, the development contributions or development fees. We got a real challenge, and you may know the numbers better than I, but pre-construction condo sales are down 71% from a year ago. So projects just aren't getting initiated, and even if they're getting initiated, they're not getting sold enough such that you can get construction financing. And so therefore, a lot of developers are pens down on new condo developments. What's the impact of that going to be?
Well, I will introduce another thought. At the end of last year, you were bang on. Condo sales were extremely slow, probably the slowest they've been in recent history. Coming into the first half of this year, sales have picked up. You are seeing see them coming in, not as fast as before, obviously, but I think there's a renewed optimism now with the rate cut. I think you are going to see some more activity on that side. But unfortunately, we have lost quite a bit of time over the last year with the slowdown in sales, which means projects aren't getting delivered as soon as they otherwise could have, as you said.
So I'm encouraged if you think that condo sales, at least pre-construction condo sales, have increased. That's not what I hear. What I hear that resale sales might be doing okay, but resale sales are 30% below pre-construction condo sales at a price level right now. So people are still trying to hold price on the pre-construction condo. And there's something like 80 projects in the Toronto area that have stalled in the past 6 months. So I worry that this housing crisis that we're in is only going to get worse. The supply crisis that we've got is only going to get worse. And it's because of high prices, because of high construction costs, because of high interest rates, because of the scaring of investors out of the marketplace. For all those reasons, plus more in regards to opposition toward Airbnb, opposition toward vacant units, foreign buyers, etc. So getting those pre-construction condos high enough so that you can get the construction financing is a real challenge today.
It is a challenge, but being in the industry, I have a lot of people that are close to me that work, at development companies. The well-capitalized developers, they're looking for land. They're doing deals. They're buying, old apartment buildings that they want to redevelop. So there has been obviously, some doom and gloom in the media as it relates to this. But the experienced groups are pushing forward and setting up their pipeline for the years to come.
Well, with doom and gloom comes buying opportunities for those that are well capitalized. So, it's the
True.
smart money that buys when markets are down rather than buys when markets are up. Um, so you said that you are a private REIT. What's a REIT and what's a private REIT?
So a REIT is a real estate investment trust. It has units and gets income from its income producing properties, which then pays dividends to its unit holders. Those units can sometimes be listed on the stock exchange like the TSX. So for example, Rio can. Or they can be a privately owned REIT, not listed on an exchange. So we are one of those private REITs.
So if you're not on exchange, how do you go about raising your money?
Um, uh, we have private capital through our investors who own the company.
And so is it people that are accredited investors that are the people that invest in your REIT, or can anyone invest in your REIT?
No, it's privately owned by a small group of investors right now.
And the private REITs, so I'm told that public REITs need to have a market value over like $1 billion. Is there a similar benchmark for a successful private REIT?
I don't know, to be honest. But it's an interesting question.
So I think that one of the big benefits of REITs is that you are able to flow to your investors pre-tax cash flows. Is that correct?
I believe so, yes.
So, when was it, a decade or whatever, maybe even more than a decade ago, we had income trusts that were ways that, former regular companies could flow their pre-tax earnings to investors. And I think it was Jim Flaherty on Halloween night, some night, announced the end of income trusts, that you could no longer have income trusts that would flow pre-tax earnings to the investors. Why is it that you can still do that in the real estate market?
It's a good question. To be honest, I don't really know. I think the REITs have been around for quite some time, and a lot of retirees and a lot of individuals rely on the income that comes from these organizations. So there's been a lot of benefit, to many people for these types of structures over the years.
And if you didn't have a REIT and you had a corporation, there would be corporate income tax, and then you would declare a dividend, and the dividend would be income to the investor, and they'd have to pay income tax, albeit with a dividend tax credit on it. So there would be two levels of taxation on the investment monies earned. If there's two levels of taxation, one would think, particularly given all the brouhaha about the increase in capital gains tax rate, the inclusion rate, one would think that the amount of investment in the sector would go down if you had double taxation and you got rid of REITs. Is that not correct?
That would make sense to me.
So I do think that one of the big benefits of the REITs or limited partnerships, because they would do the same thing, they would allow the streaming of pre-tax earnings to the investors, really is one of the reasons why we've actually got such a healthy real estate business. And we've, if anything, talked about that we don't have enough investment in real estate. We got to have increased supply, at least in the residential sector. And so I think REITs are a very important part of the way that we invest these things.
I agree.
So what's your sense? We've got this housing crisis. Are we going to solve it? Or are we going to be sitting here a year from now or 2 years from now with an even worse situation because supply is even more constrained?
I'm an optimistic person by nature, and I'd like to say, things are going to be moving in the right direction. But I think we have to do more, and we have to do more quickly. And it's going to take a lot of courage and fortitude from our leaders to make some hard decisions and put us on the right path. I think that's what it comes down to. Just do more. Throw everything you can at this problem because it affects everybody, as I said.
So you know what, Jeff, I typically am an optimistic person as well, but I have to say on this one, I don't agree with you. I really worry that even though the federal government, the provincial government, even some municipal governments have been talking a lot about affordable housing and about increasing the supply of housing, almost everything we're doing is going the wrong way. You know, I see the increase in DCs that we started talking about 42% this past year. Being local governments almost thumbing their nose at the need for incremental housing. The fact that, yes, we did the right thing, as you pointed out, in getting rid of the HST on purpose-built rental, but why just on rental? Why not on ownership when a lot of people want to own? I think that that was a huge mistake. The CMHC low-cost financing that you also identified takes 6 to 9 months to get. Everyone, complains about the incredible bureaucracy. I think the zoning regulations and rules and the time to get approvals that StatsCan and CMHC is the worst in the Western world, and that the city that we all live in, the Greater Toronto Area, is the worst in Canada, and we can't seem to get our act together to actually streamline it and get rid of red tape. And NIMBYs and this new word about CAVE, communities against virtually everything. And just this past week in the newspaper, they talked about how, there's developments that were ready to go. And even developments owned by the city out in the Portlands, where density is dramatically less than it should be. And community groups get up in arms against it. I think we are going to be in the same situation we're in a year from now, and potentially and probably worse. We are building 20% of the housing that we need, according to the statistics. And that means it's only going to get worse.
Well, I hope you're wrong. I really do. I love our city and I love our country. And, I want to continue to attract investment here, and attract people. I hope for the best.
So if you were the minister of housing, what would you do tomorrow morning when you woke up?
I would take a hard look at these DCs, and I know that's not necessarily in his purview, but that's how we started this conversation, and I think it's a very important issue, and I would take a hard look at those.
Jeff Thompson, thanks so much for joining us today. I think that the role you're playing in raising some of these issues is critical to us potentially getting down your optimistic route than my pessimistic route, because we need smart people like you challenging politicians, challenging industry people, challenging everybody to thinking about, how we can do better. So I really appreciate it. Tell everyone how they can check out your X Spaces podcast.
Well, thank you, Brian. Appreciate your time and having me on. You can find me on X at Jeff D. Thompson, and our space is on every Thursday at 12:30 p.m.
Jeff Thompson, thanks for joining us. That's our show for tonight, everybody. I thank you for joining us. I remind you, I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online, even from downtown Toronto at www.saga960am.ca. Good night, everybody. Thanks, Jeff. Really appreciate it.
Thank you.